Insurance policies help manage the cost of damage. This can be from severe weather events, wildfires, earthquakes, lightning strikes, and so many other perils, many not related to weather. Still, there are situations where insurance may not cover a loss or only cover part of it. Let's consider deductibles. That's where a portion of the loss is paid by the policyholder. Or underinsured losses. This is where there's insufficient coverage for the loss that occurred. And there's also uninsurable losses and unidentifiable risks. Think about COVID-19. The impacts of COVID-19, a peril not covered under many policies, were particularly impactful on businesses. Damages included loss of business income, potential worker compensation issue, extra costs for safety measures, and ongoing expenses with no corresponding benefits, such as rental costs for unused office space. Now, by adopting a proactive and comprehensive approach to risk management, businesses can better navigate these uncertainties and business risks. Dan Carlson has built a company around helping businesses survive after disasters and thrive in some of the most challenging insurance markets we've seen in years. Van is the founder and manager of SRA Admin, a company that focuses on risk assessment for businesses and utilizes Section 831 of the Internal Revenue Code to help businesses plan for the unexpected. An 831B plan can provide businesses with a financial buffer for many situations. Think of it kind of like a 401k plan where it's okay to take some money out for emergencies before you retire. So come and explore some of the challenges businesses face in today's environment, managing risk, and some of the creative solutions that are available. I'm Kevin Peterson. Welcome to Weather Heroes.
Well, today we're lucky enough to be joined by Van Carlson. Van is the founder of SRA 831B Admin. I believe SRA stands for Strategic Risk Alternatives. Welcome, Van.
Yeah, thanks for having me on your show, Kevin.
I was looking at your tagline, Weather the Storm. And obviously this is called Weather Heroes, and that really intrigued me. And as I studied more and more about what an 831B is, I thought I'd really got to talk to Van and hear how this works. So, Van, if you'd start off with a little bit about you personally, your personal story of how you became who you are today, you might say, this bringer of 831s.
So a couple things. I've been in risk management for almost 30 years now. I would say that's pretty much been my professional life, and really got into 2008 due to the Great Recession. When I knew about 831Bs, and obviously I'm going to dive into a little bit what exactly that is, but it is a risk mitigation tool for business owners that are essentially self-insuring risk. And unfortunately, when 08 hit, I bear witness to a lot of business owners taking financial risks that they've taken on, unbeknownst to them, right? I mean, they knew about accelerated depreciation. Every year, they were just betting every year was going to be better than the previous year, and they just kept leveraging out debt. And unfortunately, they get themselves caught up in a great recession. And that's when I figured, how to be a smarter, better way of doing business. That's really when I became a real believer in this program. So it's a risk management tool. It started in 1986 Tax Reform Act. That's when the code was originally introduced. So just like a 401k, an 831B, it's just where you find it in the tax code at the federal level. Like I said, it was introduced in 1986. And back in 1986, very similar to what's going on today when it talks about traditional insurances. But the biggest driver in the 80s was crop insurance. Farmers were finding themselves self-insuring crop insurance. Private sector was getting out of it. Obviously, today, it's fully federally backed by the federal government. It's one of the largest, it is the farm subsidies that farmers have, substantial subsidies when it comes to the crop insurance. Very difficult to be a profitable business just because it's just not you having damage. It's the neighbors, it's the county, it's the state you live in, all having been hit at the same time for either drought, tornadoes, windstorm, stuff like that. So that's really where it originated from, the 831B tax code. And really here's what it is. If you're going to have, not to get too geeked out when it comes to risk, it's an exciting part of our business. Nobody wants to talk about their insurance or the risk profiles of their business. But as you mature as a business owner of anybody that owns property or anything else when it comes to businesses, operations, risk does play a factor in it. How do you manage your risk more effectively and efficiently? What an 831B allows you to do is use pre-tax dollars to handle the risk more effectively. So, for example, when you talk about risk finance, traditionally, I can find an insurance policy, pay a premium, transfer that risk to that carrier for a certain dollar amount of premium. That's a form of risk financing. Either I'm going to pay it annually, the premium, or I'm going to pay it monthly or quarterly. Then there's some risk that this retains on your books, and that's called unfunded liabilities. And then it comes down to, how do you want to finance it? Do you want to use pre-tax dollars or after-tax dollars? So what an 831B allows you to do, if you elect under that, to deduct a full deduction at the operating company level, expense it, drop it into an 831B, and now you're building up a tax-deferred rainy day fund, war chest, whatever you want to call it. And that's what really Congress wanted farmers specifically back in the 1980s, was because they were doing crop insurance. Obviously, there's a lot of advantages using pre-tax dollars when it comes to self-insuring risk. So fast forward now, I got into it because of 2008, because of the Great Recession. Unfortunately, I saw a lot of financial risk business owners took. And then you get into COVID. Obviously, that was the glaring business owners for probably the first time, most of them, that I don't have business interruption for this. I mean, if it wasn't for PPP and ERC and those types of programs the government rolled out, your traditional insurance was never going to trigger business interruption. So, and business interruption is really designed to maintain the capital of the company, right? Meaning if I have a fire or a flood in my office and I can't operate, my insurance policy will trigger business interruption. It will also fix the resulting damages from the flood or the fire or whatever. But meanwhile, I got to be relocated. I got to go move to another office. I got rent to pay at the old one and the new one. I've got to make sure I got my payroll. Business interruption is going to trigger all those. We call that a sub coverage, where you got to have a primary loss first, and then these other coverages come into play. Well, a good example with COVID, simply put, there was no triggering event that was on their premises. It was just, you either were essential or your customers stopped coming to see you. That's why PPP and the government had to step in. One of the reasons why, and I appreciate being on your show, is, just getting the word out on that, bringing knowledge to the table or an education, is this is the new PPP program. I mean, we have been talking with Congress for a while now about what's Plan B, folks. I mean, I hope to God in our lifetime we won't have another COVID. But what happens if we did? What are we doing differently than we did back before 2020? And that's really resonating with a lot of people, honestly.
The IRS created this tool to be utilized by primarily farmers and others of that ilk, and really is something that can be utilized by business owners to help fund non-covered events or partially covered events. For example, like you talked about COVID, where it never triggered a lot of coverages. Perhaps some areas protests were not triggering coverages. Even a loss where you have coverage if you've got, let's say, large deductible as well.
Right.
So this is where you're talking about the new PPP, really.
Yeah, exactly. And so, a good example on the weather, catastrophic losses, right? Today, in order to, we're really busy in Florida right now. Wind is being excluded. Some of the buildings are going ACV, which means actual cash value minus depreciation, which means they're not covering the building for replacement today, which it's also put a big stress on the insurance industry just because of the replacement costs have outpaced even normal inflation because of material cost and everything else. So, it's unfortunate, but a lot of the clients that have been buying traditional insurance for many, many years, they are paying more, but they are getting less coverage. And that's one of the things that we're seeing a lot of around the country, not just on the coastal states, but in the Midwest. We're dealing with a lot of farmers and dairymen in areas that with health coverage, for example, it's gotten so darn expensive, first and foremost, but there's so many, we think traditional insurance does a good job. I'm not here to replace or talk badly about traditional insurance by no means. They have to do what they have to do. And one of the things that traditional insurance has always done is charge appropriate payment for the risk. And if they can't do that, then they're either going to exclude it or they're going to limit the risk. And they also know the consumers can only afford to pay so much. At some point, you're going to call no joy. In fact, we've had these conversations this past year with especially a lot of coastal properties that are paid for, that don't have loans on them. They're just self-insuring it. They're not going to take any policy out, which is, man, I don't like that. I've sold insurance my whole life. When I start hearing this, I was just in Miami. In fact, I was talking to a couple of business owners, and they know situations where businesses had a qualified buyer, but could not get the proper insurance for the financing requirements, so either through SBA programs that they were requiring, or just because there are so many exclusions in these policies now, or they're limiting replacement to ACV. And of course, the bank doesn't want to loan on that stuff because If they have a loss, they're only going to get a fraction what the loan is. So it's holding up sales of businesses, shockingly, to the point where I'm worried about that. I'm worried about that for our economy. I'm worried about, because it's called velocity of money. We got to have velocity of money in our country in order to keep the ball rolling, because drives our GDP. It drives everything around us. I mean, we've been in an inflation market for quite a while now. My concern is when you don't have velocity of money going on, you have the potential for deflation, which is a scary situation. I can tell you there's homes that have fallen through in Florida that if they don't pay cash for the home and they got to get a mortgage, they can't get insurance, they're not buying the home. So there's a lot of this stuff going on. In Naples, Florida, for example, I know there's homes, I want to say from Hurricane Sandy, about 2 years ago. I know there's homes still haven't been built yet because there's co-insurances are so darn high because it falls under hurricane coverage versus a fire. Fire, they would have had a traditional deductible. But because it was a hurricane loss, they've had to come in with more money, sometimes 20% of the value of the replacement. If you got a $5 million house, 20%, that's $1 million you got to come up with.
So businesses in particular, as we're looking at markets like Florida, California, other challenging markets, are coming across the normal challenges as insurance companies reassess their risk, but things like you talk about, inflation, other things that may be undercovered or not covered at all, that are probably stuff that really were not as impactful perhaps in the past, are becoming even more so now. So an 831B is a tool that these businesses can use. Can individuals use an 831B, or is this really just for businesses?
It's for business. So if you can write off your work comp, your general liability, your property coverage and stuff like that, you can write this premium off as well. That's kind of the line in the sand kind of thing.
So this premium is really the money then that business owner is putting aside to pay these unexpected expenses, perhaps, or overages.
Yeah, exactly. And you can put up to 2.8 million. There's rules and regulations, and so think of us as a 401k administrator or an 831B administrator. That's what SRA does. We are the largest manager of these plans around the country.
Okay.
We work with a lot of strategic partners all over the country, between CPAs, financial planners, property and casualty agents, where coverages are stressed either because markets are getting out. Insurance markets they're having less options for more. Good examples, Florida and California, because they just have a lot less carriers than they did a handful of years ago. And unfortunately, it's going to continue. If you go back in 1986, when this code came out, we're about 3 years into a 13-year hard cycle. We could be looking at a hardening market of commercial insurance for quite a while. Or you might have a stabilize of premium, rate increases stabilizing, but then that just means there's more exclusions being put into the policy. I always tell business owners, it's not because if you're PDF, we used to do the 3-hole punch, put the policy in the binder.
I remember those days, yeah.
Now everything's a PDF. And I just, jokingly, if your PDFs files getting larger from the previous year, it's not because they're offered you more coverages. It's because they put more exclusions in it. And I can remember back in the day with mold, when mold was first an issue, insurance industry didn't know how to handle it. And of course, they just came out and excluded it. And a lot of business owners are, especially if you're in the habitational apartments, commercial real estate, any of those types of things. So you have a lot of exposure to mold, unfortunately, and that's totally self-insured today. And it can be very expensive to remedy dealing with disaster cleanup companies. So those are the things that we've been bared witness to over the years, where you don't know how much self-insuring risk you've taken on until you call your insurance agent. And that's one of the things that frustrated me as an insurance agent was, man, Mr. Such and such client. These clients become friends of ours, right? They become, not only they help pay your family and help grow your business and refer business to you, they become personal friends. And then you sit here and tell them, hey, they're not going to be covered, and here's why. There was a lot of those conversations when I was a traditional agent, having those conversations. And the fact that we can do these types of things today, and I would say this, the 831B is part of the solution. It's certainly not the complete solution. And it may not be a good tool for you. I think business owners, anybody that's listening to this, never heard about an 831B. It's unfortunate. Code that was abused by estate tax planning folks that were out here promoting an estate tax tool more than a risk mitigation tool. One of the if you start diving into this, there's similar people out there like us. But one of the things we find out if the risk managers first and not CPAs or attorneys first. Okay. And if they're those, they're probably going to have alternative reasons why they want to sell you this versus just doing risk mitigation. We're good underwriters. We assess policies. We underwrite risk. We understand gaps of coverages. And how do you fill those gaps? And again, it comes down to awareness. And do you want to use pre-tax dollars or after-tax dollars?
What type of businesses have you mostly been seeing or been helping?
Quite honestly, we're across the industry. Here's what's cool about our business. We run into some clients that do some really unique things, and they do very well.
Mhm.
And I tell the unfortunate part about that is the more unique your business is, the more niche consulting you do, or the product you might design, or anything that kind of stuff, the more unique it is, the more gaps you're going to have in traditional insurance, because traditional insurance, they just put a chassis together and it's a blanket policy. It's a one glove fits all mentality. And they have to do that to scale, right? The language has to be the same. I mean, it's insuring thousands of commercial buildings. But if you do something unique in that commercial building that you may have a unique risk profile, don't expect that insurance policy you're buying to be the same. It will be the same kind of policy of the building next to you, but there's going to be a totally different operation in there potentially that would exclude any kind of coverages. But again, until you sit down with a real risk manager, it's one thing to go out and hire an insurance agent, a broker, to go out and find you the best price, the best coverage. But are they doing a full assessment of your risk management? And what I would say to you is, just based on what's going on in the world today, with forget COVID, forget cyber risk, forget dispute resolution, forget the supply chain risk, forget brand protection, just dealing with weather today has become so unpredictable. And there is so many things that are back in you as the insured that wasn't there 5 years ago. And again, it comes down to how you want to handle the risk. You've got the risk. It's undeniable. And unfortunately, you can talk to people in the Carolinas right now. They're finding out for the first time, unfortunately, a lot of them, that they're not going to be covered for a lot of things. I think it was projected for the amount of losses in the last two hurricanes that hit the southern U.S., it's like 25 cents on the dollar is going to be covered by insurance. The rest of it's going to be uninsured.
Oh, yeah. Well, a whole lot of that, if you think about it, they were not particularly flood prone until they get this unusual situation of I was talking to a meteorologist who told me, well, the ground is already like a full wet sponge. Here comes the weather from the hurricane.
Right.
Unusual. But again, that's what insurance is usually there for, the unusual. But flood is a different creature coming out of the government. So as a company, let's say they're going to call you and they're going to say, Van, I want to set one of these up. Walk me through that process. Is there a captive process? I mean, how does that look?
So this vehicle we're going to set up is going to be a C Corp. And again, we're their administrator. We're no different than the 401k administrator you would hire to administer your employment and your retirement plan, right? So we're going to make sure we stay in our lane. We're going to make sure those stays tax deferred. We're going to underwrite your risk. We're going to identify risk you're self-insuring for, or let's say you have huge deductibles like you were mentioning, or there's ACV, actual cash value minus depreciation in your language of your policies. So we know there's a gap coverage now going on versus ACV versus replacement. We can start to fund for that. So we'll go through a pretty serious underwriting and risk strategies with our clients. And then they say, okay, let's go. And so we'll help form the company. There's shareholders involved because it is a C Corp. The operating company can own it, or the owners of the operating company can own it. We're pretty black and white on that. And then we start to underwrite your risk. We come back in with a dollar amount. Hey, this is the most you can put in based on the ceiling, based on our methodologies that we use for actuarials and underwriting. And after that, it's a commercial policy chassis that we form, that if you got a unique risk, we'll even build policies around that specific risk. I mean, we've been doing this since really since 2008. So we've gotten pretty good at it. And we know the different industries. We know a lot of the exposures that they're self-insuring for. Really, and then that's put the train on the tracks. Monitor the risk. If you have claims, we have a formal claims process you got to go through. One of the 4-part tests that we make sure all of our clients adhere to is the last one is called the principles of insurance. So you got to act on the principles of insurance. So that's really where there's got to be a claims process. There's got to be some underwriting. There's got to be policies issued and delivered. You actually got to own the risk. If you're not subject to the old adage, if you're in Wyoming, why do you have hurricane coverage, right? Those types of things, that's where we stay in our lane. And then we work with their trusted advisors, their CPAs, their financial planners, their property and casualty agents. And a lot of times, and truthfully, you sit down and listen to the business owner. The longer you've been in business, you've had, if not one, a handful of times where you thought insurance was going to cover something and it's not covering it, or it didn't cover to the level you thought it was going to cover. So a lot of times it's the business owner telling us, hey, this is where I'm losing sleep. This is what I think this is my blind side I'm concerned about. And how do I handle that blind side more effectively? And again, it comes back to is utilizing tax deferred dollars. And here's the thing too, Kevin, if you're having a good year, just to take a little bit off the top and park it off to the side is not only just good risk management, it's just good business.
Oh yeah.
Because you don't know. You don't know. And then let's be honest too, the business owners have never had an incentive to save money. They've had all the incentive in the world to spend money because that's where all the deductions sit.
Right.
This Congress passed this back in 1986, where the world was dealing with crop insurance and there were some liability claims going on and they had some tort reform and all that good stuff. But fast forward almost 40 years later, not only did they have weather additional, I mean, we're not having near the weather issues we had back in the 80s as we have today. There was no such thing as cyber risk. There wasn't a thing called brand protection because you didn't have that kind of reach like you do today with content, the way we do things today, the way we advertise and market, and in the supply chain. The global economy we're sitting in, where small to middle market business owners are so dependent either on for suppliers in other parts of the world to provide a product to them so they can manufacture their product, or you're selling globally too. So now you got to stretch the supply chain risk. Of course, after COVID, I think that's really where it showed itself. And then you got the hardening of the insurance market going on, where again, you're paying more and you're getting less coverages, and that burden will fall on you. And it's happening all over the country.
Have you been working with companies of all different sizes?
Yeah.
Is there a maximum size at all?
No. I mean, we're dealing with companies that are $1 billion a year companies. And I would tell clients, if they're not making more than $1 million in gross revenue in their operations, we want to make sure our clients win, meaning that, that's just kind of we'll tell the client the good, bad, and the ugly. Obviously, there's fees involved in our program. So if it doesn't make sense to them, we'll be the first ones to tell them. And we hope they all grow to a point at some time where they can do our program, because eventually all successful enterprises, you'll get to a point in time where either you're done growing or you're just, we all kind of get into a protection mode, right? Or, and the other thing I would say too is that, because of this risk strategy that we're putting in place for business owners, it actually helps them take on more risk potentially, where they know they got this backstop, they got these dollars out here on a tax deferred basis. So maybe that will embolden them to take on more risk in other areas where maybe they wouldn't in the past.
Where do you see all this going long term? I mean, obviously you've mentioned a lot of challenges. I see a lot of opportunities or need for something like this. How do you see this going in the next 10, 20 years?
I think it's going to become a normal business practice. And it's not because of the taxes and all that stuff. It's simply the risk profile. Traditional insurance companies don't have the appetite to take on more risk anytime soon, maybe never. I think they're staying in their lanes and they're not willing to expand to other, I would say, merging risks that we have today. The world's gotten complicated. It's gotten much more complicated in the last 40 years. The world has shrunk, honestly, right, to the age of information. And when it comes to traditional insurance companies, I don't still see them responding quickly enough in that. I mean, it's a slow moving industry anyway. So that from that standpoint, it's just going to be from a risk management tool. So we think it's going to become a normal business practice where we've got a great lobbyist group in DC. We've been talking with congressional leaders. We've worked the last 2 to 3 years just bringing the education level up. I'll talk to a CPA today that's never even heard of this code. And of course, it's frustrating to me is like there's only 2 tax codes that allow business owners to take deductions and still keep the money. One's a 401k and the other one's an 831b. They know all about the 401k, but they know nothing about the 831b. But Congress is really getting behind this. Some of the congressional leaders, especially in states that are highly stressed. I mean, in the Carolinas, Florida, California, and it doesn't matter what side of the aisle you're on, by the way. A lot of their constituents are concerned about their insurance program. I'm worried about it from an economic standpoint, meaning, we live in the world of velocity of money. And man, I tell you, if you can't get the right insurance and you can't do the deal, it's one thing to be worried about interest rate. But man, when you can't buy the right insurance to be able to cover that loan covenants requirements in the loan, you can't do the deal. That's going to stifle our economy potentially. And that's concerning. I mean, we have a huge transfer of wealth going on. It's not because people they're not sitting on stocks and bonds. They're sitting on a small business. And that small business over the next 10 years needs to be sold. You're talking, these are 3 million businesses they estimate that are owned by people in their late 60s. And over the next 10 years, that transition's got to where's that going to come from? My hope is that this becomes a normal business practice to where CPAs will start to refer more, and really the ones that are out there that are true tax planners put this in their, another arrow in their quiver, right? So when they see a client, run into a client, has a unique risk profile, self-insuring a ton of their own risk, unbeknownst to them, that this would be an avenue or a part of the solution to the problem is utilizing an 831B.
Yeah, this makes infinite sense to me. Van, as you look at the future, what's the one thing you would tell a business owner to be looking for? What piece of advice would you give that person?
As business owners go, we take a lot of risks to do what we do. It's not easy to turn an idea or take on a business and turn it into a profitable company. I think you owe it to yourself to always look at these types of tools. Honestly, if you're competing against Fortune 500 companies or any sizable company, they're all doing this. They've been doing it for literally decades. The reason why you haven't heard about it is because honestly, their Deloitte's not their CPA firm. You might have a local CPA firm agent or a person in your town, They don't know about these types of codes, unfortunately, and they're not going to bring these kind of ideas to you. You have to be your own advocate, not only from a risk management standpoint, but also from a tax standpoint. And so, it's not easy what we've done. It's not easy to get to where you got to. Now, how do you preserve it? And how do you make even the transfer down to the next generation if that's goal of mine? These are tools that can be utilized in a lot of different ways. So I think anytime you own a business, you got to look for all the advantages you can when it comes to your tax strategy and also your risk management strategy that you owe to yourself. You owe to the employees that are trusted you to work for you to make sure you can meet payroll and do all those things. You owe it to yourself and you owe it to your family to look into tools like this. And if it's not the right time, it's not the right tool, then fine. But at least you're better off knowing that these types of things exist. And really, you got to do some due diligence on this thing.
So Van, how do folks find you?
The best place to go is really our website, 831b.com. We got lucky, got that domain, and that's the best place to go. There's a lot of educational videos on there. There's some great case studies in there. Again, I would start there as part of your due diligence. And if they want to talk to me directly, I'm happy to do that. I've got a great team. We work with a lot of strategic partners all over the country. I'm Van, V-A-N, at 831b.com. If they want to email me directly. We want to bring awareness, education, and just hey, you're the business owner, man. You make your own decisions, but becoming aware is huge. And so again, 831b.com would probably be the best place to start.
And we'll also add that in the show notes, Van.
Okay, thanks.
Anyone who's in a business, has a business, should be looking at something like this wholeheartedly, immediately if they haven't already.
Yeah, thank you. Appreciate being on your show.